Don't beware of the stealth bear market. Be aware of it instead. Watch this video to find great stocks that are giving us opportunities very shortly in the future. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. A stealth bear market could be defined as a bear market where several stocks have fallen more than 20% within the market, but yet the overall market itself hasn't fallen. And that's, of course, why we call it a stealth bear market. And as Mr. Valuation, I'm going to tell you candidly, I've been waiting a long time for what I'm starting to see really unfolding in an extraordinary way. I found over 70 stocks in the S&P 500 that are in beyond the bear market. Beyond a 20% drop, they've fallen 40% or more. I call them fallen angles, and that's a play on words. In other words, the angles that these stocks were trading at, the high valuations, were simply unsustainable. And as always, as I've preached many, many times, valuation eventually rears its beautiful head, if you will. Okay, because valuation matters, and it matters a lot. But this bull market we've been in has been one of the longest running in history, and it gets people believing that they're geniuses in the bull market because even though they're overpaying and taking a great deal of risk, stocks continue to rise. But we're going to dissect that a little bit within this video. So let's go ahead and turn to the fast graphs and let me illustrate what I'm talking about. All right, I want to start with the S&P 500 ETF trust here. And what I want to point out to you is that, for especially those of you who aren't familiar with the fast graph tool, the companies here, the S&P 500 is comprised of 500 companies. I found 72 of them that have had more than a 40% decrease off of their all-time highs. That's why it's called a stealth bear market. A lot of people aren't seeing it. If I look at the market itself, we know that we've been in a volatile period recently, but that's how much the market's fallen in the last couple of days. And of course, that's attracting a lot of headlines and a lot of concern by a lot of investors. But when you see it in this perspective, it's really not something that hasn't happened many, many times before, as you can look in history. Now, the orange line on this graph is a valuation reference line that draws a 15 PE ratio. That's kind of a barometer, if you will, a measuring stick. That would be an intrinsic value for most stocks. Okay, and then the 19 PE, which is the blue line on this graph, shows the average valuation trimmed, highs are trimmed out and lows are trimmed out, of what the market has traded at. As you can see, the blue line runs kind of through the price very consistently. And obviously, anytime the price is above either of these lines, it's above, in other words, here we're seeing above 19 times earnings, and here we're seeing right at 19 times earnings. All right, and then of course the orange line is 15. So if it's above the orange line, it's above 15. And if it's below the orange line, it's below a 15 PE. And this just gives you a perspective. Just using your powers of observation, you can look and see what the market has traditionally been. Now, historically, normally, the market would trade between that band of, let's say, 15 to 20 times earnings. That would be normal valuations. Doesn't mean you can't make money when the market's trading at a high value, because you can clearly see the market has gone way up since then, but it does mean you might be taking more risk than you should, because really, these are measurements of risk. All right, so the S&P 500, starting, as you can see here in 2013, coming out of the recession of 08 and 09, it traded at a 15 multiple. This was a very attractive time to be investing in the S&P 500. These other times here were still good times, but you can see the valuation started to get high. But then we've even seen a high valuation persisting for many, many years. And that gets people thinking that it's okay, instead of recognizing and being aware of the fact that they're taking on greater risk than they should, and that risk can possibly have long-term consequences. Okay, but the point is, this is the market. The market's begun to correct, apparently. It did have a correction which kind of ended in around November or December of 2023. It obviously got very highly valued. PE was over 23 in 2021, and we saw a correction, and we're experiencing what looks like a correction now. Now, I believe the market should be selling down at this orange line, but the blue line is what it's been historically trading at for at least the last several years. So if I shorten this graph just to about the last, I'm going to call it 10 years because I've got 2.5 years of forecast on here, the market's been trading at that 20. Now, this number is not really different than the number I just had up there. I also want to make that clear. It's a reference line. It's a valuation reference line. So the market, even during this period, has for most of the time traded between 15 and 20 times earnings. Okay, and that's just simply a measuring stick. Now the market is obviously above that. When it got above it in 2022, we saw the correction back below the blue line, and now it looks like it's moving back towards the blue line again. But that's the overall market, and this really doesn't look that bad. But let's go ahead and look at what I called the fallen angles. Now, this is a play on words. They're not angels. These are fallen angles. These are stocks that have fallen by, let's say, more than 20%, many of them 40%, or even some of them 50%, and some of them even 60 or 70%. But because the market has been so benign looking, we don't really see that, and the people aren't really focused on the fact they still believe we're in a bull market. But it's been a bear market for these 70-some companies. Now, I could have probably expanded this list to well over 100 if I was a little more lenient in my thinking, but I was looking for real corrections here as a value investor. So there are 72 companies that have had major corrections in the market, mostly out of sight and out of mind of most investors. You can see some really good names in this list, okay? But for the sake of this video, what I did was I created 2 additional videos, and I called these Fallen Angels, okay? Because these are very widely recognized companies, most of them, that have had great track records, but have been trading at what I even call, in many cases, nosebleed valuations. In other words, valuations that were significantly above what common sense, prudence, and sound economics and fundamentals would dictate. But in many cases, this went on for years, and that's the insidious part. The longer it goes on, the more it lulls people to sleep, believing that it can continue. And that's what the phrase "a genius in the bull market" comes from, where you got stocks, the market's just pulling everything up, and all these stocks are continuing to rise, even though they've gotten into really dangerous valuation territory, and the risks become high, but people aren't aware of that risk, and they don't focus on that risk because they're giddily making money. And what I've always said as a portfolio manager, I hate bull markets because bull markets scare me. Because when a stock falls from being massively overvalued, as I'll indicate here in a moment, it could take more than a lifetime for them to come back to where they once were. On the other case, or in contrast, undervalued stocks, as long as the fundamentals hold up, and I want to emphasize, as long as the fundamentals hold up, we usually recover very quickly and end up turning out to be great long-term opportunities. Now, not all of these first group of stocks here, where I've got 14 in the Fallen Angels list, are there yet, but you're going to see some of them are, okay? But these are even stocks that we can even start watching, and in many cases, certainly take a position in today at a much more attractive, lower risk valuation level than they were even a year or 2 ago in some cases. So let's quickly go through them, and I'm just going to use operating earnings here as the only metric. Remember, FastGraphs gives you all the metrics, but I want to put on a short commercial here. One of the beauties about being a FastGraphs subscriber is that you can see the detail. They always say the devil's in the details. Well, the angels are in the details also. In other words, by using FastGraphs, you can really get a much stronger perspective of stocks in general and the market in general, because I always say it's a market of stocks, not a stock market. In this video and this presentation kind of really verifies that. And as a value investor, I've been waiting a long time for this situation to happen, but it's really happening, and it's starting to happen more and more. So let's start with Align Technology here, a healthcare supply company. And you can see that the stock traded within that range of, say, this is a very fast-growing stock, grew by over 24% a year. So in this case, the orange line is using the P equals growth rate Peter Lynch formula. So it was trading at a 24 multiple. And it did that for many, many years, as you can see. But then every time it got crazy valued, where the PEs got up, like here we got up into the 70s and 80s, we see this big correction. And we saw it again. We saw a great earnings year in 2021. That gets people all excited, and they run the stock up to, again, these nosebleed valuations where the PE got up here to over 77 times earnings back in September of 2021. But look at the correction. Now, here was one correction, but then it rallied and corrected again. But as of today, the stock now has fallen over 71%. Now, that is what you call a bear market. But now the stock is getting close to being at fair value. Now, I'm basing that based on what I see on the historical chart here. If we look going forecasting, growth looks like it's slowing down. So this stock might still be overvalued today, but that's where research and due diligence comes in. But regardless, if it is or it isn't, you have to just simply acknowledge that it's a lot better investment today than it was back here in 2021 for most of the year. Okay, moving on quickly here, the next stock is American Tower. Now, American Tower has been a popular real estate investment trust. It's a telecom tower or cell tower real estate investment trust. And it's a very high quality REIT. It's got a BBB minus rating. It's got a lot of debt, but REITs tend to have a lot of debt because they're buying real estate. But the point I want to make is here, this particular REIT has traditionally sold at about 23 times earnings. But then we had this period of time where it got up into the 30 times earnings. It's currently trading roughly in line with its normal PE, maybe slightly under it. But again, I want you to see the correction. Even back here, where the stock corrected and rallied, if you held it to here, you would have made literally no money owning this stock for the last 4 or 5 years. Yet the REIT continued to perform as a business, and I want to really emphasize that. They continued raising their dividend, and they continued to produce very good adjusted funds from operations I'm looking at here. They were very stable. They had some good solid years and some flat years, but the point is it was the culprit of overvaluation that got this particular stock in trouble. Well, it's obviously a lot better buy today than it was back here again in 2021. The bear market, the stealth bear market here has occurred. Now, it would have been probably a much better, well, not probably, it would have absolutely been a much better buy in August of 2023, and even during periods here, and it would have been a much better buy in October of 2023 and so on. But again, the bear market has happened, even though valuation stayed extended for a long time. It's just another real estate investment trust, Alexandria. You can see that it was trading at crazy valuations for the better part of 5 years here, and then it's corrected back to fair value. And again, I'm not going to do this on everyone, but this is a severe correction. This is a 50% correction. And I just want to ask you, as investors, can you stomach losing 50% of your money? Now, the problem is, it's a different story. If you hold a 40 or 50% loss from a stock that's basically reasonably valued, or even this won't be that big, but, oh yes, it is. It's a 43% loss. That occurred from October of 08 to July of 09, so that was pretty swift. But look how quickly the stock recovered off of the lows. And if you'd have still held it, just in a matter of a couple of years or a year, it was trading at a much higher profit. And then, of course, it was trading at these crazy valuations here. But now the correction has occurred. All right. And that's the point I want to make, is that the market can, one of the old jokes is the market can be irrational longer than you can be solvent. I don't buy into that, but the market can be irrational, and it's dangerous when you get these valuations. Again, Crown Castle, which is another cell tower REIT, they've commanded high valuations. That's been a fact of the market. Can't argue with that. But they got even crazy back in 2021 and 22. But now the correction has occurred, and they've actually gotten down to where they're trading at a 15 multiple of adjusted funds from operations, which might make them attractive. We'd have to go into the forecasting graph to see that. I always want you to remember, you don't buy the past, you learn from the past, you invest in the future. But here we've got the value investor, Mr. Valuation's revenge here, if you will. This overvaluation lasting for all these years finally corrected, and corrected with a vengeance. The next one I'm going to look at is EPAM Systems, which is an IT consulting company. This is, again, pure growth stock, no dividend. There's no white line or light green shaded area in this graph. But look what happened when the valuation got crazy. Now, I've never denied that this can't happen with stocks. What I have tried to point out and tried to share with my viewers is that when this is occurring, you're in periods of extremely high risk. Even back here, if you'd have been holding the stock and watched it Again, I can do this with fast graphs. I can calculate and watch it increase another 35 or 40% or even more because I didn't hit the very top there. But yet, even then, if you'd have been holding it here and held it today, now you've got 2 or 3 years here where you've lost 60% of your money totally. You've had an annualized loss of 25% a year. And yet, again, if you look at the business itself, it had some really good years here and some flat years here, but it didn't lose money. It wasn't going out of business. It doesn't look like it's going out of business. But what happened was the culprit of high valuation and high risk would have caused anyone who's holding the stock for the long run to lose a great deal of money. Moving on, Lululemon, very popular apparel and accessories and luxury goods company, normally trades at a very high multiple because it is a very fast-growing stock. I want you to notice the growth is 25%, and the orange line in this case is a 25 PE, but that's a high PE for a high growth stock. And it was okay because the stock traded within those bands. But then it got crazy overvalued, and now all of a sudden we see this big correction. Even from back here, the stock has had a huge correction over the last couple of years, over 48%. And the other thing I want you to notice, not just the magnitude of these losses, but I want you to see the volatility that begins to happen when you get high valuations like this. The next stock I'm going to look at is Nike. Now, Nike was trading at normal valuations for all these years back in the early 2000s. And then all of a sudden it started to deviate from the fair value. And this is the crazy market. It did have a flash crash during COVID, and the earnings did drop because obviously it was in a lot of retail stores. But then it recovered very quickly. Earnings recovered, and so did the price. But once again, the risk of owning Nike here, AA rated with only 39% debt, superb company, was just absolutely exposing you to be vulnerable. Earnings have flattened and sales have flattened, and the stock, of course, has had this huge correction. And I'm not hitting highs and lows here. I'm just kind of generally picking spots here, but that's over a 50, we'll call it a 55% correction, a negative 23% annualized rate of return since from August 21 to October 21 to August of 2024. We got almost 3 years of significant losses, and to expect Nike to get back to this valuation, I believe, would be a false hope. If you bought it here, is a time where you got to take your loss and move on. And Nike is, but I still don't think Nike's attractively valued, by the way. I do want to make that clear. I think it still has room to fall. Now, growth is expected to be negative this year, but then start growing at double-digit rates. I'd like to see it down here at least a 15 PE, which is actually this first blue line. So it's not quite as bad as this chart would imply because you're only averaging 1.19%, but you're actually looking at the opportunity for 2026 and 2027. Now, this has a May fiscal year so that you're not confused. Okay, so in the next couple of years, growth is expected to start returning, and Nike may then become a good buy. But the point is, we had this long period of genius in a bull market valuation, and then we've had this massive correction. Moving on, here's Paycom Software, a very hot stock, very popular, trading at all these high valuations for all these years. And then the weight of the high valuation is simply caught up. And once again, we can see that the drop has been almost 70%, over 30% annualized losses for the last several years. Valuation matters, and it matters a lot, people. Moving on to be quickly here, PayPal was a classic example, commanded very high valuations, then it had crazy valuations, and now we've got the stock trading at a reasonable valuation of 15 times earnings. And by the way, everybody wanted to buy the stock here. Nobody seems to want to buy the stock today. I'm long PayPal, by the way. I do think PayPal is a good buy at these prices. Here's SBA Communications, another cell tower REIT. Again, these traded at these very lofty valuations. You could occasionally, for just short periods of time, be able to buy these at attractive. Keep in mind, if you bought it here at this attractive valuation, you're still making over 11% a year during this time frame, despite all the volatility. But had you bought it up here when the valuations were high, and again, I don't want to hit the peak, and held it to today, over this 4 or 5 year period, you're actually losing money. Losing an average, you're down 25% over the last 4 years. annualized loss of about 5% a year. And that's including the dividend. Even though you paid a dividend, you're still losing money. So moving on, this is one I featured recently. This is an AI opportunity, technology and hardware. We've seen this huge growth. The stock reacted, and to a great extent, this reaction was valid up until about here. Okay, but then we had this big bump up here where people got, as Alan Greenspan once called it, irrationally exuberant. And now we've seen, with the earnings still holding up and going very nicely, we see a stock whose price has fallen over 40% in just a very short period of time here because it's moved back into alignment with earnings. Now, is this a good buy today? This stock could be a very attractive buy today with a high growth rate. This is a high risk, high growth stock, but it's obviously, and common sense would say, if you wanted to play AI, super microcomputer might be the answer. Now, you want to do your due diligence. It has a reasonable amount of debt, no dividend. It's strictly a growth stock, but this might be a real strong play in AI. Next would be Teleflex, healthcare equipment. Once again, used to be a normally traded stock, as it should be. Then we had this crazy bull market we've been in, and valuations got really extended. And again, Mr. Valuation's revenge. We're seeing these stocks actually succumb to the weight of their overvaluation, and we're seeing these 40 and 50% drops. And again, I don't know many investors that can stomach that kind of drop. But if you were a Fast Graph subscriber, you would have been aware of this the whole time. You would have been aware of the fact that you were paying an extremely high valuation. You could have still done it. You could have still made the decision. It's a hot stock. It's got plenty of momentum. I'm going to stay with it. But at least you'd have been investing with your eyes wide open, as I often say. The next one on here is Wisconsin Energy. I showed this one because this is my favorite utility stock. It's one of the fastest growing utility stocks in America. It's very, very consistent growth. It's A- rated. You can see the earnings have grown just like clockwork year after year. The dividend has grown like clockwork. This normally would trade between 15 and about 18 times earnings. Then we got these really high valuations. And so for the last several years, it's been a very poor stock, even though the company's still been a great company. Now you can buy it with over a 3.75% yield. It was obviously a better buy a couple of weeks ago. It would be a better buy if it got down to the actual orange line here, like I'd like to see it. Xcel Energy, which is another really good utility stock that is very similar to Wisconsin Energy, has the same kind of metrics, if you will, consistent earnings growth. It got really highly valued. You can just clearly see this would be poor time to be investing in this utility stock. You generate no rate of return. You literally have dead money for 4 or 5 years. But yet if you bought it, even in spite of all that, if you were buying it at an attractive valuation somewhere in here, even today after the big correction, you'd be averaging over 9%. And that's dividend and growth. So valuation matters, and it matters a lot. Now, having said that, those are the 14 what I call truly falling angels. I'm going to go quicker now. I've got another 12 in my classic falls, I call this, in other stocks. So let's look at a stock like APTIV Plc here, who was a dividend-paying stock and trading at reasonable valuations. Had this collapse, earnings started to grow, and the market ran the price up. But again, look at the correction. Valuation is the only thing that differed. The company was actually doing great, is actually doing great here. And yet during this time when the business was doing great, the stock was doing horribly. And that's why I showed this. It fell over 50% in value because it was never worth this price during this whole time. It was just hype. I have a run-on money management firm called Earnings Determine Market Price, and you're seeing that over and over again here in this video. And that's in the long run. And that's what you're looking at here. There's an evil twin sister, as I always say. Emotions determine market price in the short run. And that's what you're seeing here and here. Okay, when emotions rule, it doesn't persist and it doesn't last. Again, here's American Water Works, a water utility, very popular. Used to trade somewhere between 15 and 20 times earnings historically. Got really crazy overvalued. It's been in a downtrend ever since. I think it's overvalued today, but you can see the stealth bear market I talked about in the correction. Ball Corporation, metal glasses and plastic containers, very solid company, always traded at a normal valuation when the market was being sane. Then we got this insane market, valuations got high, and the stock has collapsed. It's rallied again, but I still think the stock is only worth what the orange line says. Clorox, obviously the bleach company, got crazy overvalued, and I pointed it out in the video, and now we've seen this correction. When a stock is overvalued like this, they're very vulnerable to flat and dropping earnings like you see here, okay? And so the stock has had this enormous correction. The price has fallen from 210, 211 down to 142. It's clearly seen that. Here's Charles River Labs, another example of a stock that traded at reasonable 15 to 20 multiples, got crazy overvalued, and you've seen it fall. Even though this is happening, my argument is don't believe your lying eyes. The valuations are too high. Dollar General ran into some trouble. They were trading at really high valuations. The market gave it a strong correction. And by the way, I'm showing you examples where the fundamentals stayed generally good, strong. Now, they might have had a down year of earnings like we saw with Dollar Tree here, which brought the stock collapsing. But this business is still reasonably healthy. There's always been cyclicality here. Okay, I'm going to show you an example at the end. Before I do, here's Estee Lauder, the personal care, fragrances, and so on. Got crazy overvalued. Mr. Valuation's revenge kicked in. Here's Eversource Energy, another really good electric utility with very consistent earnings growth, like I showed you with Xcel and with Wisconsin Energy. Once it got overvalued, the price went nowhere for a couple of years, and now it's come back into what looks like an attractive valuation. Generac, the generator company, got crazy overvalued back here in 2021. Once again, we see this steep correction. Mr. Valuation's revenge kicking in. Genuine Parts is a milder example, but still a good example, a very good company. You can see the valuation got crazy. Anytime the valuation got high, just notice how it really kills the opportunity to make any money in the stock, even when the business does well. But yet when you buy it at low valuations, even when you run into trouble, you still get a chance to make double-digit returns. Valuation matters, and it matters a lot. Okay, moving on real quickly, of course, we have Tesla. Now, the normal PE kind of distorts this picture, so I'm going to take it off. You can see how crazy valued Tesla got, and we've had all this extreme volatility, and the stock has been performing pretty badly here recently, but I still consider it to be massively overvalued. Now, I do want to show you one other thing, because valuation is not always the answer, okay, and the only answer, but it's an avoidable answer. I want to show you a stock like FMC, which is a fertilizer company. Here we have a case where it never really got crazy overvalued. It did get some high periods of high valuation, which it almost always immediately corrected, but it was not until earnings collapsed that we really saw the collapse. This is in contrast to what I've showed you so far, but yet it's also a stealth bear market. Stocks like this are having these drops, and a lot of us aren't aware of it. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzers tool, a.k.a. Mr. Valuation, gleefully sharing with you what I call Mr. Valuation's revenge. I've preached and preached and preached that overvaluation is dangerous. It's very risky. Doesn't mean you can't make money for periods of time, but you've got to really watch your stocks like a hawk. It's like playing musical chairs with your money. Everything's great as long as the music is playing, but when the music stops, you better have a chair underneath your money. And that chair always turns out to be solid fundamentals, because fundamentals matter, and they matter a lot. If you like this video, give me a like, ring the bell, and for goodness sake, be a smarter investor. Take a look at subscribing to FastGraphs. Take our free trial if you haven't already subscribed. I wouldn't even imagine investing without it, and just as this video illustrated, it gives you such a clear perspective of what's really going on in the market, rather than being essentially led by the hype and hysteria that you often see in the financial headlines and the major financial news sources. Thanks for watching, and talk to you again real soon.